Hello, and welcome to the last session of the Future of Work and HR stream happening today at CogX 2021. The sessions and the stage today have been curated by the Institute for the Future of Work. Please do get involved by asking questions through the chat function in Hopin via the Q&A and by starting a conversation on social media. The hashtag is CogX 2021 and the @ is Future Work Inst, which is Future Work INST. Now, this final session of the day is really highlighting ESG investment and good work. The pandemic has reminded us all of the role that companies play as social institutions with social responsibilities to their employees and the communities in which they operate. Government support has changed the pact between corporation and society, and this requires a higher level of responsibility and scrutiny. Against this backdrop, those at the Institute for the Future of Work think that companies are likely to be judged according to how they have treated their employees through the crisis, and that there's a compelling case that corporate behaviour to the workforce will be key to post-pandemic recovery. So how can we best judge and reward companies that are being good employers? Well, one of the answers lies in establishing a clear framework to help investors and companies establish good work principles and practices. Environmental social governance, ESG, investing is going mainstream with over $40 trillion of assets under management globally. This session will explore why sustainable work should be core to understanding and measuring ESG investment and how the Institute for the Future of Work's Charter for Good Work can help. Bringing in today our moderator, Daniela Barone Soares, CEO of Snowball. Hi, Daniela, how are you doing?
Hi, very nice to see you. Thank you for being here, for inviting us. So I'd like to introduce the two panelists and let them actually introduce themselves. Jamie Broderick.
Thank you, Danielle. Hi, everybody. I'm Jamie Broderick, and I'm a board member at the UK's Impact Investing Institute. Before joining the Institute, I was the head of UBS's wealth management business in the UK, and before that, CEO of JP Morgan Asset Management Europe. The Impact Investing Institute is an independent nonprofit with a mission to accelerate the growth of the impact investing market in the UK and internationally, and also increase the effectiveness of that market. Basically, we'd like to see more capital contributing to the well-being of people and planet. And it might help to understand our work if I gave you a definition of impact investments. So these are investments made with the intention to generate positive and measurable social and environmental impact alongside a financial return. They can target a range of returns from below market to market rate, depending on the investor's strategic goals. Now, we're really aware that a lot of the interest in impact and sustainable investing these days is focused on environmental issues, especially the climate crisis and carbon emissions. So our focus is more on the social issues. We try to raise awareness of the role that impact investing can play in addressing urgent social issues, including those that arise in the context of addressing the climate crisis. So for example, we were part of a group of organizations that successfully lobbied the UK government to start issuing green bonds, and they'll be doing that later this year. But we were also able to convince them to account for the social co-benefits of green initiatives. That concept of capturing the social implications of the transition to net zero emissions is usually called just transition, and we're very active in that space. Over to you, Danielle.
Thank you. I'm Danielle Walker-Palmour, and I'm from Friends Provident Foundation. And we're formed from the unclaimed assets of the demutualization of Friends Provident back in 2002. We are a funder, but we think of ourselves as what we call a capitalized charity. When we consider our impact as a function of the work across all of our capital, and we don't call ourselves just a grant maker. Our focus is on a fair economy, one that balances current and future requirements and operates within planetary boundaries, but meets the demands of society. So a pretty tall order. We are an asset owner, and we recognize that our endowment, which is essentially most of our money, is central to us achieving our mission. We are part of the system we're trying to change. And essentially, we think of it as having skin in the game. So we don't have a lot of money, so we work it extremely hard. So ESG, as well as direct mission investing, is key to this. With our partners, we hosted the first ESG Olympics last year to bring transparency, accountability, and stakeholders into the room, into this discussion of how assets are allocated. As we work on the economy, we recognize the importance of work as an economic activity. It's social glue, it's a driver of what is both good and ill in our society. And we really look forward to the later discussion.
Fantastic. Thank you so much for that. And what I'll do before asking you a few questions will be just to set a little bit of context. And I'll start by a very, very short introduction of Snowball. Snowball is an investment fund focusing on deep impact and market returns. We have 4 years track record with a highly diversified global strategy that spans all the asset classes or across various asset classes and impact themes very aligned with the sustainable development goals. I'm also a trustee for the Institute of the Future of Work. And the context for today's session, I'd say there are 3 key points. And the first one is the pandemic, that has highlighted a problem, which I think we all know and we all knew, that the best paying jobs are not necessarily the ones that contribute most to the common good. And some of the low paying jobs have greater social value than their market value. Linked with this point is that second point. There is such thing as good work, and I think we know that. Good work helps citizens, communities, and companies to withstand those short-term crises and shocks and adapt to long-term transformations. It supports health, it fosters a sense of cooperation, and it binds communities together. So I think that's what we know of good work as well. And the Good Work Charter from the Institute of the Future of Work centers on the premise that for us to have good work, we need things like fair pay and fair conditions, equality and dignity, autonomy and participation. And so what's the role of ESG? ESG tends to work as the environmental, social, and governance issues from a finance risk-based approach. So it goes a step below impact with the intentionality, as Jamie well defined. But does good work have a place in ESG investing and in impact investing? How and what can capital flows do for good work as the economy rebuilds with greater automation and autonomy? And that's what I want our panelists to talk about today. And the first question that I'd like to pose is the fact that ESG during the pandemic more than doubled in terms of the interest on ESG investing, and it represents 40% of total assets under management globally. Now, sorry, my computer is playing. What role should ESG play in promoting good work? Who'd like to start?
I'll start because I'm going to say something straightforward, and then Jamie can say something complicated. I'm just going to say, essentially, from an asset owner's perspective, the S in ESG is absolutely central, but it's completely it's not completely neglected. It's often neglected as a part of the way we think about ESG and responsible investing. Key elements that make good work vital are essentially the central planks of what you look at if you're looking for a good company from our perspective as an asset owner. Fair pay, access to jobs, equal treatment of workers, participation in decision making. These are all elements of good labor relations and what we would want to see in our portfolios. So it's about investing in good companies. And I think as the pandemic has highlighted, the precarity of work for some people. And I think perhaps there's a better understanding of also the risks of poor working relations, actually even public health risks. And I think these things have come to the fore over the last year or so. Jamie.
Well, first of all, I totally agree with you, Danielle, in your description. I think, let me just take an investor's perspective on this. So I would say that when an institutional investor, so a professional investor, comes and looks at a company, they're looking at the environmental, the social, and the governance dimensions of that company. But what I would say is that if the analysts are really paying attention, they will know that a good working environment, like the one you just described, and high levels of well-being among employees, that's highly correlated with better investment returns. So regardless of their motivations, their social motivations, as investors, they should be looking for a good working environment and well-being among employees, because they're correlated with investment returns, with good investment returns, and they should be looking for evidence of that. And the things that they're looking for are basically companies that are displaying the elements of the good work charter, including some of the things that you mentioned. Now, there are tons of academic studies that show that employee well-being positively affects corporate performance, and ESG investors should know that. What's interesting is that a lot of company managers also know that intuitively, but the issue feels too soft to action, at least in terms of allocating budget. So allocating budget to training or better pay or more discriminating supplier selection, all those other things that might cost a lot of money in the short run, even if they save money in the long run or improve performance and productivity. Managers have a hard time getting to that. And so I think it's really important for investors to let them know that they care about that kind of thing. And I think there's so much academic research on this. I was looking at an article in Forbes the other day, and the article ended with, "What are you waiting for? Why is this even being debated?" And I think what they're saying is, if you're an investor looking for good investment returns, you should be looking for good work.
And do you think, so if they're not doing that, so do you think we need legislative changes in terms of embedding good work in the investment process?
I mean, my kind of feeling is ish, possibly. So, I mean, pay gap reporting is absolutely an important element. So we've seen gender pay gap reporting, and that kind of requirement does drive different kinds of conversations. We have noticed, though, there seems to be a slowing down on ethnic pay gap reporting, and that certainly could move forward. And again, driving different kinds of conversations. But there are other kinds of initiatives that can be taken, so we don't have to wait for legislation, because that's a slow process. The Workforce Disclosure Initiative is there, which could start driving some of those different kinds of conversations. And I really do think, taking Jamie's point, investors and asset owners need to be giving really clear market signals about what we expect through voting, through engagement from companies. So I say it doesn't hurt, but it doesn't feel like it's sufficient.
I'm with you, Danielle. I think I agree with that. I think the legislation tends to be really slow. It tends to take a lowest common denominator approach because it has to embrace, absolutely everybody on a legislative thing. And I just think that mandated disclosure makes a ton of sense to me. But after that, I think it's up to, the investing world and the asset owner world like yours are probably better equipped to provide a lot of the pressure on companies. So fundamentally, though, I think good work is a function of culture, and I think it's hard to legislate culture. I really do. I think it's really the issues that we're talking about are: do companies have a culture of fairness and a culture in which they consider the welfare of their employees and the welfare of their supply chain and the welfare of their communities? That's really hard to legislate. So I'm much more interested. I'm a capitalist, I'm an investor. I have a lot of faith in the ability of investors to really influence the way corporates behave once they communicate that this is what we care about, this is what we value. And then generally speaking, I think companies have to respond to that.
And what are there then positive actions? And I completely agree with both of you there. What other positive action do you think that we can do or that can be taken to embed good work standards into investment? So yeah, does consumer behavior have a say in that? How can we accelerate this trend? Because as you said, Jamie, I mean, some investors are looking at that. I know impact investors are, but not all investors are. And what are the various things that we can do, you think, to accelerate embedding those good practices?
Well, I'm going to sound a bit like a broken record, but I think that once we all agree that better companies make more money, and you get to be a better company by treating your employees really well, by encouraging well-being, by encouraging their product. That if you give, and if you have a good work environment in which employees experience good well-being, they will be more productive. Your company will be more successful, and you get a virtuous circle going. And I think that's really. So I just wonder, can we do more to get a consensus going within both the company side, the investee side, and the investor side? Let's all just agree and be explicit that we think companies that provide a good working environment are going to be more successful companies. And that creates a very positive kind of dimension to it. So I would say, if there are any managers out there that are confused about whether employee well-being is a good thing, if there's anybody that's confused and thinks that somehow they're not going to be more productive and the company's not going to be more profitable, then I think we need to take away that confusion, because it's really clear from the kind of work that people have done that this is the case.
But if you thought of it negatively, so could you frame it as, okay, bad behavior is just risk, and we will start pricing it as risk as investors. We'll start saying, essentially, you've got a business model which is predicated on, basically exploiting workers. I don't know if we can say actual brand names. Can we say a company starting with B and having an H in it over the course of the last year?
It's all in the news, Daniela.
So can we say, people were invested in Boohoo. Everyone knew. There were, loads and loads of articles and exposés about poor labor practice, yet people were still invested, and there was still sort of shock and horror. And I think, if we just say we're pricing this as risk, or not holding it, or shorting it, I just don't know if that's the conversation that is a grown-up conversation or not. It just feels like the way I would expect my asset managers to be behaving.
I think that's a good example, Danielle. And I think what's interesting, because Danielle, you mentioned the role of consumers, and I think a lot of institutional investors did bail out of Boohoo when this was last summer, when it became apparent that they were they had suppliers, so they had people in their supply chain supplying Boohoo, which is a retail clothing store for non-shoppers like me. I think, I'm not sure. But they had suppliers that were really, they were underpaying their people. And it was really quite scandalous how much they were underpaying their people. And so that became a problem. And a lot of institutional investors bailed out. But what's interesting is on the consumer side, this is, the consumers are not, they don't track this stuff. They're not professionals. Consumers mostly respond to press coverage, but generally speaking, their memories are short. They're not paid to track Boohoo's labor practices. That's really something that an investor would do. And actually, what happened was, so this whole thing with Boohoo broke last summer, and Boohoo's pre-tax profit went up by 37% in the year to February. So basically what happened is consumers were really fixated on this issue, but then they lose track of it and they go back to being consumers and they look for, consumer products, and they don't necessarily have a way of tracking which companies have misbehaved or whether they've changed their practices. And so I think to some degree, if you look at Boohoo bouncing back in terms of its sales to consumers, it just seems to me that it's difficult to ask consumers to apply the discipline to the companies. I don't know whether you disagree with that, but I just find it's hard. Consumers are just trying to do what consumers do. They're not specialists, and they do their best. But I think I just feel the institutional investors, the professional investors, have a serious and ongoing responsibility that I don't think consumers can really fully fill.
Especially in that case when they're sort of 12, because a lot of them were very young. One of the things also, this is a theory. Now you can both shoot me down because this may not actually be something that is a realistic thing to say, but I've always been really interested in terms of pay and conditions of companies, the separation and operation of Remcos for the senior team and the senior side compared to sort of HR practices which apply to everybody else. And that separation feels to me a blockage to companies actually taking kind of whole company perspectives on pay and conditions. So if the senior team is having a whole set of a basket of things they are getting, and then a separate bunch of people are making decisions on what is affordable by the company in terms of the rest of the company, you start getting differentials. Differentials will come through. And to me, I was wondering if that was a barrier to having decent work for everyone, because you've got different systems operating. So obviously, Jamie, you've got experience. Both of you have corporate experience. So if you didn't have those separations, would that make a difference?
And by Remco, you mean a remuneration committee?
Yes, I do.
Yeah.
Sorry. Yeah.
It's so interesting to hear you say that, because it's fascinating to me that, yeah, you're right. You're absolutely right. There are two different worlds out there. There's the senior management, most of whom will be, for example, will own stock. And then there's kind of a large population of people that are just, they're just working and they're getting their pay, and they're not really making the kinds of decisions. And I think, the culture of most companies, I would say the culture of most companies is really driven by the senior people, because unless it's unionized, in which case you get a different dynamic in there, but that's less and less frequent these days. But it's the senior people that have been around for a very long time. These are the 10 and 20 and 30-year people. They make the decisions, and they configure themselves. Their view of the world is driven by what they themselves experience rather than what their people experience. And so I agree with you that I think there's a bifurcation between the people at the top and the people in the ranks. And I think that's what creates this disconnect between the experience the rank and file have and the experience that the senior people have.
The UK sorry.
Go ahead.
Sorry, Jamie. Go ahead. I didn't mean to
interrupt.
interrupt.
Go ahead.
No, just saying that the UK Corporate Governance Code, I don't know if it's I think it's 3 years ago, something like that, has highlighted that remuneration committees have to have a broader look at the overall compensation and the various elements of remuneration of the rest of the organization, not just as it used to be, just for the senior members of it. And that has led to some changes, actually, in terms of the pressure on remuneration committees to adjust pensions and level the pension levels to the whole organization becoming the same. Because also there was yet another element of discrepancy between the salaries, that furthered the discrepancy between the salaries and the pay that senior people had and the rest of the organization. I think there's a massive challenge in this, and we can go for another complete different conference to talk about that, but there's a massive challenge in terms of the pay and the pay gap, because you have a self-perpetuating circle that is very hard to escape for senior professionals, and for people that are considered replaceable is a very different story. So yeah, and that I think is a social contract that we need to think about, and I would love to hear your views on this, because when we are hearing in the news that nurses are now completely stressed and burnt out, that medical professionals are completely stressed and burned out, that their salaries is not enough for the massive commute they have to do to then come and then work, and they were asked to do all this in the pandemic, or when we're asked, when we see that there are not enough teachers in the UK. There are not enough teachers. We can't find qualified enough teachers in the UK because of the conditions of their work, largely. And these are both vocational jobs that people do because they love it. They want to do it. So how can we address this, looking both as an investor and as an investment management perspective?
That's a big question. And I'm not even sure I know the answer, because I think it is fundamental to thinking about what good work is. I mean, one of the things that I'm really interested in is the degree to which we as a society, because this moves beyond kind of ESG, but to like our society and how we value work. But it's like, is salary the only thing? Can we start creating, an economy with work in it that actually recognizes we might have caring responsibilities, we might have family, we might have, we're not just like machines who go to work, and then we have no kind of other extraneous elements to our lives. And it's kind of understanding that, Jamie's as likely to have caring responsibilities as I am. And it's not just about, women getting flexibility. It's about everyone having flexibility, and teachers and nurses and having those supports around work, which may not be salary, but it does represent resource. And we as society are willing to put more resource, be that through taxes or whatever, into supporting people in work. That might be starting toward a better solution. But I really don't know the answer to the question. What do you think, Jamie?
Well, Daniela mentioned nursing shortage, and I don't believe there's any such thing as a nursing shortage. I think there's just underpaid nurses. I mean, I think when
teaching shortage, yeah.
I think when you or teachers, I mean, when you have a shortage of people, it does suggest that you're not paying them enough, and that kind of adjustment needs to get recognized. But I also think that if you're an investor looking at a company that systematically underpays its employees, you can't really get enthusiastic about that company, can you? So I think that, if you have something like the Good Work Charter as a form of checklist, imagine an investment analyst going through the Good Work Charter and saying, are we fair? Are we balanced? Do employees have autonomy? Just running through the charter. And you ask, if you keep coming up with no's, then that stops being an interesting investment to make. And that creates a little bit of discipline. But I do think there's something, I mean, back to, I'm just sort of fascinated, Danielle, by your observation about the bifurcation between senior and junior. And I think that if you senior managers who've accumulated stock want to see their stock go up in the short term, they already own it. And so it does create, I think stock ownership at the senior level has a tendency to compress people's timeframes. So people are no longer, they don't want their stock to go up, the stock that they already own. They don't want it to go up in 10 years. They want it to go up now. And that creates a short-term perspective when in fact the implications of good work, the benefits of good work show up over a much longer time frame than that. And I don't really, that's where remuneration really does matter. The structure of the remuneration makes it difficult for decision makers to say what's good 10 years out, what's good 5 or 10 years out. And I think anything that can be done to extend the time horizon of senior managers will be really productive, because that's the point at which you go, yes, we can underpay our nurses this year and maybe next year, and the place will fall apart, 5 years later. Whereas if I'm a manager and I have a perspective of what's going to happen in 5 years or 10 years, I need to have everybody paid in a stable and fair way. And that's one of the defects we have, and I think in the system of a lot of corporations.
Mm.
And governments, I think.
Well,
yeah. So short-termism is a real issue. But we as humans are pretty rubbish at thinking in the long term, and we really do struggle to kind of do that work, intellectual work. So I suppose I do feel like, as I say, we're very much part of the system. You know, as investors, we're wondering, you know, are we not being clear as you know, asset owners, are we not being clear enough what we want? Or are we, not, or benefiting from the current situation? I don't know how many portfolios hold Amazon, but, you know, there's definitely a question in some of that. You kind of think, well, labor relations may or may not be good, but there are certainly questions there and risk. I don't know if we're pricing that.
No, absolutely. And are there any, because I think part of the challenge when you kind of step back and think, how can we make it a general assessment from an investor perspective and an ESG perspective? You know, you kind of have the climate that you can measure CO2 emissions or greenhouse gases emissions, but in the in the social side of things, to measure culture, to kind of be able to do that is a much bigger challenge, partly because it's very hard to say that is one. There are a few measures, but they are usually lowest common denominator. You know, like, do they pay the real living wage? Do they pay, their taxes? Does this company? So are there any other ways that we can think about the S factor in ESG so that we can better incorporate and make it easier? Because a lot of the analysts, Jamie, to your point, I completely agree that they have to be doing this analysis, but a lot of them don't. Is the bottom line. Impact investors like us, like the Impact Investing Institute and the people that they support, they're doing that. Friends Provident is doing that, but a lot of people are not. So are there any shortcuts? Are there any measures of the S that investors can use?
Well, I could suggest a couple. I mean, so that if you look at the charter, it's 10 different things, so metrics for dignity, metrics for participation, metrics for learning and training, metrics for pay. I mean, there's a lot of different things to measure. It's a lot more than just measuring CO2. So that does make it extremely difficult. And how do you create metrics for each one of those? And then obviously different investors are going to have a different set of metrics. But the one thing that I think brings it all together is well-being. And if you can measure employee well-being, which is in a sense an aggregate of all the other influences, and I think that the concept of measuring, sometimes I think we're a bit too micro about things, and I think we would do a better job of asking people how they feel about their work environment, and their answers would capture their pay and their autonomy and their training and learning and their work environment. And I think that's really an interesting space. So if you look at somebody like, I don't know if you're familiar with Glassdoor, but Glassdoor, I don't know whether maybe everybody knows this, but Glassdoor asks employees, and I think they have a couple million of people who report to them, how do you feel about your company? So it's, in a sense, it's a well-being score, and it gives you a general sense. And so if I were investing in a company, I would look at what is Glassdoor? What are the employees saying? Not about the micro issues, but in general, are they happy, not happy, very unhappy, thrilled? And that does show up. So in answer to your question, well-being is one of those ways, as you say, a shortcut, but it's not so much a shortcut. I think it's because I think it's quite real, but it does capture a lot of different things that are maybe hard to measure, but each individual employee knows perfectly well how he feels about his employer. And if you can capture that, then I think that may be something that's a useful metric to bring a lot of complexity into something that's more straightforward.
That's very powerful. And I mean, the other thing I was trying to get my head around is this whole sense of understanding our workplace. So essentially, Jamie and I are probably of an age, similar vintage, where people basically.
You're so kind, Danielle.
No, I've got a lot of makeup on, but we work for, people work for companies and for organizations, whereas, that may or may not be the workforce that we're actually describing, or certainly the work, the nature of work is changing, as Daniela will know from the work of the Institute, and just all the gig economy and the lack of regular contracts. I mean, one of the things we're really working on with the Church Investors Group is actually do some engagement around regular work and regular contracts. Having a culture of thinking, can we regularize this work, even if it's not, the traditional contractual work, but there's a culture of trying to make sure that work is still decent, not just saying, oh, well, it's Wild West, whatever. They like this flexibility of having, no work if they're ill. Everyone loves that, it's great not getting paid if you're ill. That's not going to be a good plan. And just trying to work with companies to start thinking, yes, you can make humans externalities, but guess what? They're kind of not, because they're humans and we're in a society. And I know that we are very much a mission investor. So we do come at this from a different perspective, because we see our endowment as a way of achieving a social goal. But it just feels like, something, a culture or expectations that, us as asset owners need to be really signaling much more strongly. But I think, your suggestions are really good ones.
And the erosion of social capital that comes, and again, unfortunately, is not felt in the super immediate short term, but the erosion of social capital that comes from this exploitative work, and the discrepancies, that are allowed to fester as a result of that. It's enough to go to a country where that social fabric is not as solid. And I'm not saying even the UK is that solid, but you go to other places where that social fabric is weak, and then you see what results. You have unrest, you have crime, you have a population that actually costs more from a tax perspective because it's putting an extra burden on your health system. You have a population that is less educated. And so this is something that if we had that long-term vision as Jamie, or long-term horizon as Jamie was mentioning, we could probably do a lot in terms of addressing that. And as we know, the technology, gig economy is here to stay. Technology is here to stay and to help us to prosper further. But without that kind of good work charter, it could do a lot of damage. I think we only have 4 more minutes left, and I just want to sort of see if either of you have any closing remarks to the session, or anything that you'd like to say on this topic.
Well, from my perspective, I just think the charter is just really powerful. And I think that asset owners could really, as Jamie said, just be looking through these and thinking about the actual the actual headings, and thinking, well, how much does this represent, how it's represented in our portfolio? Is this something that we need to make sure we're having conversations with our asset managers about, that they have, they're using these in conversations with companies and in their fundamental analysis? Because I think it is just understanding that poor labor practice is risk, and it's risk that, it is avoidable. And we need to just, the rules have changed. It's not okay just to, treat people terribly, but have a very, very green or clean technology operating. This is all part of the same.
And for my part, I'm very excited when I see people, socially minded managers and socially minded people and socially minded companies. But I have to say that that's not what most of the world looks like. I think it's great to be able to draw on socially minded people, but I think when there is a financial discipline, I think it's a really powerful backup for the social, until we are all socially minded. I think the fact that the investment system provides some reinforcement for sourcing and supporting well-managed companies that treat their employees well, I think that's a really powerful discipline, and we should make more of it. And I think we can make more of it. So I'm looking forward to seeing that emerge more as a theme, so that companies eventually feel like their license to operate really depends on their credentials in the way they treat their employees.
I couldn't agree more. And I think as those investment strategies that take these things into consideration start to perform well as having this more multi-stakeholder approach of looking at things, then I think it would, I'm hoping, because I'm an optimist, all of us have to be when you're working in impact, that will turn the tide, whether people are interested in it or not, and whether they're socially minded or not. Actually, that makes business sense and it makes investment sense. And that is why Snowball exists.
Exactly. Exactly.
Thank you, everyone. Thank you for being here. And thanks for the contribution from the audience as well. So I think we're coming to a close.
Thanks very much for a fantastic panel session. Thank you, everyone, for joining the Future of Work and HR stream on the first day of CogX 2021. Today's sessions were curated by the Institute for the Future of Work, so please check out their website and social media. The hashtag is CogX 2021 and the @ is Future Work Inst. We've heard from such great thought leaders on the importance of good work and trends for the future of work and how that's shifted over the last few years. The panels and sessions today really highlight how the ways in which organizations are showing up for their people, customers, and society is going to be a tangible indicator of how their organization is perceived as we look to recover. A key takeaway from the sessions is that leading with people-first thinking, sort of enabled by technology, ensures that we don't deepen the digital divide as we adjust to the new. The Institute for the Future of Work's Good Work Monitor and Good Work Charter look at how we can equip people with the tools to do so. I'm Nimi Patel from Tech UK, and I've been your host today. There are still panel sessions happening across other stages of CogX, so please do have a look at those. But that's it for the Future of Work and HR stage. Thanks from everyone at the Institute for the Future of Work. I wish you a really good evening.